Hims and Hers Health, ticker symbol HIMS, delivered a massive revenue beat, but a huge earnings miss for Q2 2026. Revenue came in at $753.2 million.
Which is huge.
Yeah, that is up 38.2% year over year, easily crushing the Wall Street consensus estimate of roughly $699 million. But earnings per share came in at a GAAP loss of 37 cents per share, missing the expected 5-cent loss by a mile.
Right. A total miss on the bottom line.
Exactly. And forward guidance was raised significantly. Third quarter revenue is projected between $880 million and $900 million, and full year 2026 revenue guidance was bumped up to a range of $3.1 billion to $3.3 billion. Yet, despite the raised guidance, the stock just tanked. It closed the regular session at 31.77, but gapped down sharply, falling 6.3% after hours to 29.77.
Which tells us immediately that Wall Street is looking right past that top-line beat, even
Yeah.
staring directly into a margin crater.
Yeah.
When a company posts a 38% revenue increase and the stock immediately sheds over 6%, you are witnessing a fundamental re-rating of the underlying business model in real time.
Okay, let's unpack this. We are looking at the Q2 earnings report, the SEC filings, and some fresh analyst notes from firms like Needham, Bank of America, and Citigroup.
Lots of different opinions in those notes, too.
Oh, absolutely. So our mission for this deep dive is to synthesize all of this data to answer one core question for you. Why is the market aggressively selling off a stock that is, ostensibly anyway, growing like a weed?
Right. We need to figure out what the street is seeing under the hood.
Exactly. And to start making sense of that post-earnings drop, we actually have to begin with their revenue engine, because the sheer scale of their growth right now is, well, it's the only way to contextualize the costs that are suddenly eating into it.
It really is an aggressive pace of expansion.
Yeah.
I mean, they added 300,000 net new subscribers just in this quarter alone.
Just in one quarter. That's wild.
Yeah. That brings their total subscriber base to nearly 2.9 million, up 19% year over year. Management was quick to point out on the call that having 2.9 million active patients, it gives them a scale comparable to some of the largest traditional brick-and-mortar health systems in the United States.
And they are extracting significantly more value out of those subscribers, too. The monthly revenue per average subscriber, the ARPU, jumped 21% to $92.
$92 a month. That's a very healthy subscription.
It is. So let's break down where that cash is actually coming from. The U.S. segment is still the core of the business, rising 15.7% to $621.8 million. But the headline shocker here is the international revenue. It just exploded to $131.4 million.
Yeah, that number is staggering when you look at the historicals.
Right, because for context, a year ago, international revenue was just $7.5 million. That is nearly a 17-fold increase in 12 months.
And underlying that kind of growth, you really have to look at the unit economics. They are reporting long-term retention rates of over 85%, and their customer acquisition payback periods are sitting at under 1 year.
Less than a year to earn back the marketing spend?
Exactly. In the world of direct-to-consumer healthcare, getting your marketing spend back in under 12 months on a customer base that sticks around 85% of the time.
Yeah.
I mean, that is essentially the holy grail of subscription economics.
Yeah, definitely.
Plus, they noted that the Hers brand specifically is on track to hit $1 billion in revenue entirely on its own.
Wow.
Which is a massive milestone considering women's health is traditionally a highly fragmented market.
Look, I hear those numbers, and it sounds like a subscription box that suddenly went viral globally, but with medical-grade stickiness. But I have to push back on this top-line narrative just a bit.
Okay, let's hear it.
If you are listening to that 17-fold increase in international revenue, you really have to wonder, is this truly organic growth, or are they just buying their way to these massive numbers?
Because of the acquisition.
Right, because that spike to $131.4 million was largely driven by their recent acquisition of the Australian telehealth company, Eucalyptus. You buy a massive asset, your revenue naturally spikes. It doesn't necessarily mean the core domestic engine is accelerating.
Well, it's easy to look at the Eucalyptus deal and say they just bought revenue, but that ignores what is actually happening domestically. Even if you strip out Australia completely, the U.S. organic engine still grew by nearly 16% to scale past $621 million.
Fair point.
So that shows the core machinery is still humming. The Eucalyptus acquisition wasn't just about buying top-line numbers. It was a strategic shortcut to global supply chains.
Oh, so?
Integrating a foreign health entity means you are acquiring their local regulatory approvals, their established pharmacy networks, and their existing clinical infrastructure. Management believes that bolting Eucalyptus onto their existing tech stack really validates their unit economics on a global stage.
But as we're about to see, buying your way to international scale is incredibly expensive, and it fundamentally changes the financial profile of the company, which brings us to the actual mechanics of that EPS miss.
The margin collapse.
Exactly. The top line looks incredible, but if you look under the hood, the financial engine is severely strained. The margins absolutely collapsed this quarter.
Yeah, if we connect this to the bigger picture, you have to look at the gross margin degradation. A year ago, their gross margins were sitting at 76%.
Which is fantastic.
Right, and back in 2023, they even peaked at 82%. But in Q2 of 2026, gross margins plummeted to 64%.
Wow.
That is a massive 1,200 plus basis point drop. Right now, HIMS is valued like a high-margin software company like an Adobe or a Salesforce where every new user is almost pure profit.
Yeah, the classic tech multiple.
But a 64% margin makes them look significantly more like a traditional heavy asset pharmacy. It's like discovering your favorite sauce company is suddenly opening up brick-and-mortar factories.
And that compression flows right down to the profitability metrics. Adjusted EBITDA dropped to $60.3 million. That is an 8% margin, which is exactly half of the 16% margin they posted back in Q1 of 2025.
Just a brutal haircut.
Yeah. Then you look at their operating expenses, or OPEX. It skyrocketed 48.4% to $577.9 million.
The breakdown of that OPEX is where you really see the sheer physical strain of this scale.
Yeah.
General and administrative expenses G&A surged an astonishing 145.8% year-over-year to $165.4 million.
145% increase in G&A. That's just wow.
I know. Technology and development jumped 45.1% to $54.9 million. Operations and support increased 43.6%. When your underlying operational expenses are growing significantly faster than your 38% revenue growth, well, your bottom line is going to flip.
And flip it did. They reported a GAAP net loss of $86.3 million. Just to put that into perspective, in the exact same quarter last year, they posted a $42.5 million profit.
A huge swing.
We went from a healthy profit to an $86 million loss. So if you're looking at that 145% spike in general and administrative costs, you're probably wondering how much of that is permanent bloat and how much is just the one-time cost of swallowing an Australian company. Why did these costs spike so violently?
There are three main culprits driving the burn here. First, and most importantly, is their heavy pivot into branded GLP-1 weight loss products.
The compounding.
Exactly. We need to be clear about the mechanics here. Instead of buying pre-made FDA-approved pens from pharmaceutical giants like Eli Lilly or Novo Nordisk, HIMS is leaning heavily into compounded GLP-1s.
Right.
Compounding means they're paying specialized facilities to mix the raw active pharmaceutical ingredients completely from scratch.
Which changes everything.
It does. That requires highly specialized sterile labs, rigorous batch safety testing, and complex cold chain shipping logistics. It completely destroys the cheap, scalable margins they enjoyed when they were just tossing generic finasteride pills into a padded mailer.
It is a fundamental shift in business physics. I mean, they are transitioning from moving bits, meaning digital prescriptions for cheap generic pills, to moving heavy atoms, meaning refrigerated cold chain logistics for injectable peptides.
Exactly. The second major cost driver is the actual integration of that eucalyptus acquisition across multiple international markets. You're dealing with redundant tech stacks, integrating different patient databases, and aligning compliance across entirely different regulatory regimes.
It's never as clean as the pitch deck makes it look.
Never. And the third culprit is that they absorbed $81 million in non-recurring costs this quarter.
Wait, $81 million in just one quarter?
Yeah. That $81 million included massive restructuring charges, breaking old facility leases, legal accruals, and transaction expenses tied directly to closing the acquisition.
So they are sacrificing today's profits for tomorrow's scale, which is the classic Amazon playbook. But is a 1,200 plus basis point drop in gross margin acceptable just because they want to chase the trending GLP-1 weight loss craze? I mean, going from an 82% margin business to a 64% margin business completely changes how Wall Street analysts run their discounted cash flow models. You aren't commanding a tech multiple anymore.
And that margin penalty is exactly why the stock dropped after hours. The market is struggling to price in this new reality.
Yeah.
The transition from high-margin generic pills to lower-margin, high-demand weight loss injectables is fundamentally mutating the company's financial DNA. Management is acutely aware of this, which is why they are trying to aggressively reframe the narrative right now. They desperately want to avoid being valued as a low-margin pharmacy.
Which is fascinating because if you read through the earnings call transcript, you see management pitching a very specific forward-looking narrative to defend this cash burn.
The AI pivot.
Right. If you are the CEO and Wall Street is panicking over your shrinking margins, you can't just promise things will magically get cheaper. You have to change what kind of company they think you are. And that's exactly why they suddenly started using the word AI heavily on this call.
Over and over.
They are claiming a strategic pivot, moving away from being a single category telehealth provider and evolving into an AI-native global consumer health platform.
The operative word they're leaning on is platform. They are taking the upside from their massive revenue growth and reinvesting it directly into two specific buckets: international footprint and AI functionality.
Okay.
The stated goal of the AI is to drastically improve customer engagement and clinical personalization. We are talking about using machine learning to integrate complex lab diagnostics, tailoring precise peptide therapies to individual metabolisms, and utilizing predictive modeling to anticipate what treatments a patient will need before they even ask.
Here's where it gets really interesting. Are retail investors actually buying this AI platform narrative, or is AI just the magic buzzword executives deploy on earnings calls to distract investors from a $97.2 million quarterly operating loss?
It's a fair question.
Because labeling yourself AI native is the easiest parlor trick to try and command a tech multiple on Wall Street right now.
It is a completely fair skepticism. However, if you look at the mechanics of their ARPU, the average revenue per user, it did jump 21% to $92. AI is theoretically the mechanism driving that.
How so? Like mechanically, how does that work?
Well, by analyzing behavioral and clinical data from 2.9 million users, their algorithms can surface personalized, higher-tier treatments. Instead of doctor prescribing a basic $20 generic cream, the platform analyzes the intake data and automatically suggests a $200 custom compounded topical specifically formulated for that patient's skin type.
Oh, wow. So it's an upselling engine.
Exactly. If the AI is actively upselling customers, reducing churn, and improving clinical outcomes, it is functioning as more than just a buzzword. It is a legitimate engine for customer acquisition cost arbitrage.
But the market's reaction suggests investors want to see the AI generate actual operating leverage. They want to see OPEX going down, not just revenue going up.
Right, show me the leverage.
Management is asking for a lot of patience here. They explicitly stated on the call that they expect to return to net profitability by 2027. And their long-term targets are incredibly bold. They are targeting $6.5 billion in revenue and $1.3 billion in adjusted EBITDA by 2030.
From a strategic analysis standpoint, management clearly used this as a necessary transformational pivot. You can only grow so far selling generic lifestyle medications for hair loss and ED. To reach $6.5 billion in revenue, you have to capture significantly more of the patient's holistic healthcare journey. That means owning complex weight loss management, ongoing diagnostics, and having a footprint in Europe and Australia. They see the current margin compression as the necessary near-term toll they have to pay for long-term global dominance.
Which forces us to look at the immediate reality of their balance sheet. A promise of profitability in 2027 feels like a lifetime away for a market that aggressively punishes cash burn today.
Absolutely.
Let's look at the immediate risks, starting with the cash flow. Free cash flow was negative $68 million for the quarter. And to fund these ongoing operations, the company just raised $350 million in convertible senior notes.
That's a lot of paper.
It is. Raising $350 million in convertible debt when your stock is already down 66% from its highs isn't a move you make from a position of power. It's a move you make because compounded drugs are incredibly capital intensive and you need a war chest immediately.
That debt raise is highly significant. It brings their total liabilities up to $3.30 billion against total assets of $3.63 billion.
That's getting tight.
Very tight. Convertible notes are essentially debt that can be converted into equity at a later date, which means they are accepting potential future shareholder dilution to secure a lower interest rate today. Now, they do have about $841 million in cash equivalents, and short-term investments on the balance sheet.
So they aren't going broke tomorrow.
Right. They are not facing a liquidity crisis tomorrow. But that negative free cash flow is a trend the street is watching like a hawk. When you transition into heavy physical logistics, cash burn can accelerate surprisingly fast.
Then there is the insider selling. We saw notable insider selling recently, which, never helps the optics.
Never.
The chief financial officer offloaded about 7,000 shares, and the chief operating officer sold roughly 14,000 shares.
This raises an important question about optics versus corporate mechanics. It is vital to note that if you dig into the SEC filings, these transactions were executed under prearranged Rule 10b5-1 trading plans.
Right, the automatic sales.
Yes. This means the executives set a schedule to sell these shares months in advance, completely blind to what the upcoming earnings report would be. Furthermore, some of these sales were mechanically triggered to cover tax withholding obligations related to the vesting of their equity awards.
Just standard plumbing.
Exactly. This is standard corporate plumbing for a publicly traded company.
Mm.
But when the stock drops 6% after hours and margins are shrinking rapidly, insider selling, even pre-planned mechanical selling it, never makes retail investors feel warm and fuzzy.
Add the legal overhang to those optics. The FTC has ongoing consumer privacy litigation against the company. Plus, multiple shareholder rights law firms like Kaplan Fox and Scott plus Scott have announced investigations into potential securities law or fiduciary duty violations by the directors and officers.
Yeah, you see those pop up quite a bit.
You do. And to be completely clear, we are reporting these strictly as allegations and preliminary investigations. No wrongdoing has been established, but it adds an undeniable layer of headline risk to an already volatile stock. So what does this all mean for the analyst community who has to actually put a price target on this thing?
Well, the street is highly divided, which perfectly reflects the tension in the business model. The overall consensus is a hold with an average target of around $32.57.
Okay.
But the individual firms are taking wildly different stances depending on what metric they prioritize. Needham raised its price target to $42 and maintained a buy rating.
So they're bullish.
Very. They are fully buying the management narrative. Needham looks at the GLP-1 market and sees a total addressable market so massive that even with margin compression, the absolute dollar value of the EBITDA HIMS will eventually justifies the heavy investments today.
On the other side of the aisle, Bank of America raised its target slightly to $32, but kept a neutral rating, specifically citing limited near-term upside while they wait to see if the eucalyptus integration actually bears fruit.
A much more cautious approach.
Yeah, and Citigroup actually cut its target down to $33. Citi is clearly looking at the gross margin degradation and deciding to sit on the sidelines. They are applying a margin penalty because they view this new capital-heavy revenue stream as lower quality than the old software-like revenue stream.
It is a textbook battle between growth investors and value-conscious investors. Growth analysts look at a 38% revenue jump, nearly 3 million subscribers, and strong international expansion, and they say buy.
Right.
Margin-focused value analysts look at a drop from 76% to 64% gross margins, an $86 million net loss, and negative free cash flow, and they say wait.
So you have to ask yourself, with 63% institutional ownership and the stock currently down over 60% from its 52-week high of $70.43, are you stepping into a value trap? Or is this a generational buying opportunity for a growth stock in the middle of a massive transition?
That is the multi-billion-dollar question for anyone looking at HIMS right now. If management successfully integrates eucalyptus without further cost blowouts, stabilizes the compounding margins on their GLP-1 injectables, and actually utilizes their AI platform to significantly lower customer acquisition costs over the next 4 quarters. Well, today's price looks like a deep discount.
God.
But if the cash burn accelerates and the debt load becomes cumbersome, it's a trap.
So if we step back, the tension here is incredibly clear. HIMS and Hers is an absolute revenue machine right now, growing at a blistering 38% clip with nearly 3 million sticky subscribers. But financially, the transition from moving digital bits to moving physical atoms is acting like a margin wrecking ball.
A wrecking ball is a good way to put it.
They are actively sacrificing near-term profitability and free cash flow to fund a massive global expansion and pivot into the highly complex, highly competitive weight loss space.
How they execute the physical logistics of this pivot over the next 12 months will completely redefine the company's valuation multiple.
Which leaves us with one final thought to ponder. We've talked a lot about the massive revenue growth driven by these branded, compounded GLP-1 weight loss drugs. But could the very thing driving their top-line explosion right now actually become a commoditized race to the bottom?
Oh, interesting.
Yeah, as more and more telehealth competitors secure their own compounding facilities and flood the market with cheap weight loss solutions, HIMS and Hers might be forced into a brutal price war, a price war that could permanently damage the historically high-margin, software-like subscription model that Wall Street originally fell in love with. Make sure you follow the show for your daily earnings coverage.